Hi, Scott. Happy Friday.
Yeah, you as well. Take me into your psyche here over the last 24 hours. Yesterday was something, and then here we are with a bounce back.
Yeah. We're still overweight tech. One day doesn't make a trend, but I do think that the pullback was mainly due to profit taking. Shares of tech names have run quite a bit, as we know. The catalyst was lower rates. We had a good CPI report. I think investors took an opportunity to rebalance into names that perhaps can benefit more from lower interest rates. So we saw small caps rally. In fact, are rallying again today. Real estate dividend payers. That being said, we still think there's a lot more leg in the tech sector. We have earnings announcements coming out later this month. We have high expectations for that. And also positive seasonality. In the last 10 years, July has been one of the strongest months for the tech sector. So we think there's more room to run.
But are we starting a legitimate trend shift where I'm not suggesting in any way that tech can't continue to do well? It's just not going to have the kind of outperformance that it has so thoroughly enjoyed. And maybe that's where we need to be thinking.
Yeah, I think it would be tough for us to expect years like a name like NVIDIA, which investors have enjoyed triple-digit returns for the last 2 years, if you would. We can't expect that every single year. So we do expect perhaps the tech sector to fall more in line with historical returns. That being said, I do see room for other sectors to perform. A lot of these sectors are coming out their earnings bear markets, if you would, in the second half of the year. That should be a catalyst where year-over-year earnings announcements are going to be stronger, and I think investors will start to pay attention.
Well, what if I need to be more concerned about the economy than I've been? I mean, it has been strong, but it's obviously weakening. The consumer feels like it's weakening. The unemployment rate's going up. It's not like we're fully out of the woods yet.
Yeah, we take a little different view on that. We think that the economy is going into what we call in the Goldilocks scenario, where we have steady growth. It's not as robust as we saw at the beginning of the year or even last year, but call it a Goldilocks scenario where you have steady growth. It's not so hot that it causes inflation. And you would couple that with strong earnings growth, which we're expecting this year and in 2025. We still think there's a tailwind for stocks.
But, I mean, where does the strong earnings growth come from?
A lot of it is just one great management by companies. The underlying fundamentals of the economy, despite the slowing, is still strong. I think there's still cash in the sidelines to funnel growth into other areas of the economy. And if we have the benefit of slightly lower interest rates, I think that is also going to be a tailwind for the economy as a whole.
Well, what's your take on what's going on with the banks today, like J.P. Morgan down 1.25%? You own that stock?
We do. I would say J.P. Morgan, out of the whole of bank stocks, is the best run bank on Wall Street. I think the earnings quarter was okay. It was a mixed quarter, if we would say. I think the core results were quite strong. The capital markets business, the fee revenue business was quite strong, even excluding the Visa gain. I think where the concern perhaps was with the higher loan loss provisions, higher expenses. J.P. Morgan's had a wonderful run this year. So near term, probably not a lot more upside from here. But our long-term prospects remain very optimistic for J.P. Morgan.